fixed strikes and varied fixed deltas and varied strikes.
Okay.
Or fixed strikes and varied deltas. You could mix this title up. It's kind of like one of those mix and match puzzles. So we're just going to be taking an introductory view, okay, of how deltas and strikes interact in an equity index, which tends to have a lot of put skew. Okay, and the reason we're taking this segment this way is because we've had quite a lot of, I would say, complicated P&L, and let's talk about some fixed deltas and varied strikes. Something so mind-numbing you'll fall asleep after and wake up on Monday, hopefully. All right. Adjusting our approach to account for current volatility levels is key step in options trading, especially using short premium. And I think this piece, that sentence could not have been more timely than it is right now. Since implied volatility is a part of the computation for delta, trading consistent options, trading consistent options with consistent deltas is a straightforward way to accomplish this. So this actually, okay, funny enough, this is a very simple piece, but today this is like probably the best topic we could cover because today options are going to be very much affected by this. So let's explore how distance out of the money and credit received have over the years for 45 delta options with roughly consistent deltas. So how have they changed given the deltas being the same? So if you have a 20 delta option in the SPYs, how have they changed with volatility and also over time? And what you're going to see is that the delta is the key fixer, right? It's basically your default setting. And no matter what's happening in the markets, like even right now, we're going to use 15 years of data in the SPYs, and we're going to look at the 45 delta puts and calls, and we're going to look at the 40, 30, and 20 delta options. Now, the reason we're doing that is we're just kind of looking it down the curve, typically with what people would trade. Usually people trade between the 40 and the 20 delta, so that's what we're going to look at. Now, you don't have to look at those, but the trend's going to be the same for everything. Like as lower you go, the same. It's going to be kind of the same trend. We're going to look at the initial distance out of the money and the credit received, and we're going to look to see if there is anything we can take away for our personal trading and kind of understand just kind of some basic differences and trends that come with lowering the delta and what happens to the initial credit and all that stuff. So sounds good?
Sounds great.
Love it.
This is looking at the calls, and this is a graph over time, okay? And if you'll notice, the interesting thing is as the price of SPY grows over time, okay, this isn't the price of SPY, this is basically looking at the out of the money amount for the calls in SPY, okay? And if you'll notice, there is an upward trajectory. As the price of SPY grows, your 20 delta call all of a sudden becomes further out of the money to adjust for the new expected move that in dollar terms is larger, right? If you have a $100 stock, same volatility, versus a $500 stock with the same volatility, the expected move in dollars is going to be larger for the $500 stock. So the out of the money distance for the calls actually increases, which is nice because anytime we trade, we don't actually have to ever look at how expensive is the stock price, how do I adjust my out of the money distance. If I'm trading a $200 stock or a $500 stock or a low vol stock or a high vol stock, the delta automatically does that for you. So if you trade a 20 delta, you can trade a 20 delta all the time, even when the VIX spikes $6.41 in a single day. The new 20 delta option is going to be much further away to account for that larger expected move. Okay, so looking at the puts, same exact graph, but what's the difference? Notice that the actual distance between the deltas is a little bit wider than the calls. The reason? Obviously, SPY has put skew, which means that if you look at the difference between a 40 delta and a 30 delta, it can be a lot further away on the put side than the 40 delta and 30 delta on the call side. And that's intentional because you typically see 130 point days to the downside, but you don't typically see them to the upside. That's exactly why you have this thing happening over time, because the market accounts for these black swan events. Looking at number 5, and here we have the credit received. When you sell a put or call, obviously with the price going higher, you don't have to worry about the delta from an out of the money perspective, nor a credit received perspective. You're getting the fair price for the option and the distance out of the money simply by looking at delta. With volatility, it adjusts. That's why you see a spike in 2008 and a spike in 2020, because the credits do adjust for spikes in volatility along with the distance out of the money. So again, if you're going to trade a single metric and nothing else, delta would be that much. If you're looking for a specific strike on an option, what you really want to look at is the delta, because that will normalize over time no matter what stock you're trading or underlying you're trading. Same thing on the puts as the calls. The difference, though, of course, is the credit received on average is higher. And when volatility spikes, it's even higher. It's the same thing that's happening today. If you look at a new, here, let's just, for sake of example, S&P 500, if you're going to look at, I'm just going to pull on the platform very quickly. If you look at the September expiration, about 49 days to expiration, if you look at the 16 delta put right now, it's 485 strike. That's 30 and 50, $45 away.
Yeah, and
I don't know what it was a few days ago, but it was definitely not that far.
Well, I could tell you yesterday it was trading at like $1 at the lows. It's now at $5.
Right.
So,
and if you're looking,
so when everybody obviously you've had a downside move here, but that's a show of a massive pop in volatility.
Yeah.
VIX is up 7 right now.
Woo!
It's crazy. Yeah. And this new 16 delta strangle right now for September is $7.15. A few days ago, it was basically, a few days ago, basically when vol was at its lows in the beginning of July, it was trading about $4. So that's how vol can affect these, and that's why you have those spikes in the charts. That's when vol spikes, credit received goes higher. That's why you have the same thing happening today. Let's look at the last slide. So some takeaways. Being consistent with our deltas allows us to simultaneously reduce our risk and take in more credit, because when volatility goes higher, we automatically get pushed further out for our new trades because the new delta is further away from at the money to account for the higher expected move. And when you look at the puts and calls separately, it makes the put skew apparent because the puts are further apart from each other and they have more premium. And this is the key, the most important line. In an efficient market, there isn't inherently anything wrong with picking your strikes at set dollar amounts, but this approach limits our ability to take advantage of shifting size and shape of the expected moves. And even more so, it doesn't allow us to maintain the same level of probability of profit and risk and reward. The delta, if you keep your deltas the same, you keep your risk reward the same. And regardless of what happens to the stock, it may go, like, the risk may be higher now, but the risk relative to the potential reward and the risk relative to the probability of profit will stay the same as long as you maintain your deltas consistent through your trading career.
Glorious.
Glorious, sir. Thank you very much.